What if the bank account you use every day is already obsolete? What if a new kind of digital dollar is quietly moving trillions of dollars with a scale that is already starting to rival the payment giants we use every day? This isn't a prediction. It's happening right now, mostly out of public sight. We're in the middle of a silent revolution, a deep rewiring of our financial system that's putting traditional banking on a collision course with a new and powerful force. We're going to unpack the trillion-dollar threat that could upend the banking system as we know it. We'll show you how this new technology is taking apart the two things banks need to survive, and how a new law is about to light the fuse, forcing banks into a fight for their lives. This is the story of a financial revolution, and it affects every single person with a bank account. At the center of this huge shift is a technology that's still a mystery to many: the stablecoin. To get the size of the threat, you first have to understand what a stablecoin is, and maybe more importantly, what it isn't. It's not a volatile crypto like Bitcoin, prone to wild price speculation. A stablecoin is designed to be a stable digital version of a real world currency, usually the US dollar. Think of it as a digital dollar or digital cash on steroids made for the internet. It mixes the trust of a government backed currency with the speed and global reach of a digital asset. There are three main kinds of stablecoins, but only one has grown big enough to challenge the old guard. The first and biggest are fiat collateralized stablecoins. For every one digital coin out there, there's supposed to be one real dollar, or something just as liquid, like a US Treasury bill, held in a reserve account. This is the model used by industry giants like Tether, USDT, and Circle, USDC. They work like digital IOUs for real dollars, and you can cash them out whenever you want. This model has seen explosive, almost unbelievable growth. The second type is crypto collateralized stablecoins, which are backed by a mix of other cryptocurrencies. They're a cool experiment in decentralized finance, but they're complex and depend on volatile crypto markets, making them a minor player for now. The third type, algorithmic stablecoins, tried to hold their value using complex algorithms to manage the coin's supply. This category is now infamous for the massive collapse of Terra/Luna in 2022, which wiped out over $40 billion in a few days. That spectacular failure was a huge warning, but it also, oddly enough, cleared the way for the stronger, fully reserved stablecoins to lock in their dominance and get the attention of regulators and big institutions. And their dominance is growing. The total market value of stablecoins has surged to over $300 billion. But market cap is only half the story. The really mind boggling number is the transaction volume. In the last year, total transaction volume hit $46 trillion. Now, that's not an apples to apples comparison with Visa or Mastercard, since a lot of it is financial shuffling between traders. But even when you filter for just organic activity, you're left with a staggering $9 trillion moving across these new digital rails, more than half of Visa's entire volume. This isn't some niche product for crypto traders anymore. This is a parallel financial system being born, built on speed and efficiency, and it's a direct challenge to the very foundation of banking. This quiet revolution isn't just coming, it's already here, and it's getting stronger every day. To really get why this is an existential threat, you have to understand a core secret of modern banking. When you put money in a bank, it doesn't just sit in a vault. The bank uses your deposits to make loans for mortgages, small businesses, and car loans. This is the basic idea of fractional reserve banking, and it's how banks create credit, the very lifeblood of our economy. For a long time, banks in the US had to keep a certain percentage of deposits in reserve, but that rule was actually eliminated in March 2020. Now, a bank's ability to lend is determined by complex capital and liquidity rules, but the core idea is the same. They rely on your deposits as a cheap and stable source of funding to make money from lending. The whole system is built on trust and, just as important, inertia. For decades, there just wasn't a good alternative for holding and moving your cash, until now. Stablecoins attack this model at its weakest point, the deposit itself. They offer compelling reasons for people and businesses to pull their money out of the traditional banking system. This is called deposit flight, and it's what keeps bankers up at night. The first and most obvious reason is yield. In an era of low interest rates, the return on a typical savings account is often next to nothing. In contrast, stablecoins can be put to work in decentralized finance, or DeFi, to earn returns that can easily beat what a bank offers. While there are risks, the promise of higher yield is a powerful magnet pulling money out of savings accounts. But it's not just about yield, it's about utility. For businesses working globally, stablecoins are a game changer. A company paying an overseas supplier the old way faces a wire transfer that can take days and rack up fees from go between banks. With stablecoins, that same payment can be settled in minutes for pennies, anytime, any day of the year. This isn't a theory, it's happening at scale, leading corporate treasurers to see large bank balances as inefficient. The terrifying speed of this deposit flight was on full display during the 2023 banking crisis. Silicon Valley Bank saw a bank run that was shocking in its speed. One of the key moments was when Circle, the issuer of the USDC stablecoin, announced it was pulling $3 billion of its reserves from the struggling bank. It happened digitally almost instantly. It was a terrifying new reality. A bank run can now happen at the speed of a click. The sticky deposits banks relied on for centuries are suddenly dangerously fluid. Even a small shift of the tens of trillions of dollars in US bank deposits into the stablecoin ecosystem would be a seismic shock, crippling the banking system's ability to lend. The fortress of traditional banking wasn't built for this world. Its walls are digital and they're starting to crumble. The assault on bank deposits is only one front in this war. The second is an attack on a core revenue stream banks have controlled for decades: payments. Every time you swipe a card, send a wire, or get an international payment, a web of banks and processors work behind the scenes, and each one takes a cut. These fees add up to hundreds of billions of dollars a year for the industry. Let's break it down. There are debit card interchange fees, which merchants pay to your bank. There are wire transfers and ACH payments, the workhorses of business payments, which are reliable but slow. And then there's the golden goose, cross border payments. Sending money to another country is slow, confusing, and expensive because it has to pass through a chain of correspondent banks, each taking their own fee. This entire industry is built on the fact that moving money has been hard. Stablecoins make moving money easy. They run on global 24/7 blockchain networks. A payment from a digital wallet in Chicago to one in Singapore doesn't need to pass through intermediary banks or use old messaging systems. It goes direct sender to receiver in minutes for a fee of just a few cents. This isn't a small improvement, it's a total paradigm shift. It turns payments from a service bank cell into a basic feature of the internet like email. The biggest sign of this disruption isn't coming from crypto startups, but from the payment giants themselves. Visa and Mastercard, who have the most to lose, aren't fighting stablecoins. They're embracing them. They've been filing patents, making partnerships, and running pilots to use stablecoins in their own networks. They know their survival depends on becoming the main interface for the new system, not protecting the old one. And then there's PayPal, which launched its own stablecoin, PYUSD. A company that built its empire as a user-friendly layer on top of the old banking system now sees its future in bypassing that system entirely. These companies aren't innovating for fun. They're doing it out of a calculated fear of becoming obsolete. For banks, this is a devastating squeeze on their revenue. The billions they earn from payment fees are now under direct threat. While the fee advantage for small domestic payments might be small, it's massive for large business to business and international transfers. As more economic activity moves to these new digital rails, the fee income that banks have always counted on will start to disappear. They're being hit from two sides. Their cheapest source of funding, deposits, is leaving, and one of their most reliable sources of income, payments, is being undercut by technology. For years, the one thing holding stablecoins back has been regulatory uncertainty. The industry has operated in a gray area, dogged by questions about their reserves and a lack of clear rules. This has kept many large conservative institutions and the general public on the sidelines. But that is now changing. In July 2025, the United States passed comprehensive legislation for stablecoins, the Genius Act. While this law is framed as a way to make stablecoins safe, it will, in reality, be the legislative match that lights the fire. On the surface, the regulations seem smart. The law requires all stablecoin issuers to be regulated financial institutions and, critically, to back every single digital dollar with a one-to-one equivalent in cash or short-term US government debt. This 100% reserve rule is designed to prevent a Terra Luna style collapse and ensure a digital dollar is always worth a real dollar. It also brings stablecoins up to the same anti-money laundering and know your customer standards as the traditional banking system. To the average person, this sounds great, a regulated, fully backed digital dollar. What could be safer? And that's exactly why this legislation is so dangerous for banks. By providing a clear rulebook and the government's seal of approval, the law removes the final barrier to mass adoption. The perceived risk of stablecoins will drop. Corporations will feel comfortable moving large parts of their treasury into them. Everyday people will see them as a safe alternative to a bank account. The trickle of deposit flight we see today could become a flood. But the real poison pill for banks is hidden in plain sight: the 100% reserve requirement. It sounds safe, but it fundamentally breaks the business model of banking. Remember how banks use deposits to create credit? That $100 you deposit gets lent out, creating economic activity. The money held in reserve by stablecoin issuers, however, can't be used this way. If an issuer holds $10 billion in reserves, that money must sit in cash or cash equivalents. It cannot be lent out to fund a mortgage, a car loan, or a new factory. Now, imagine a scenario where trillions of dollars move from the fractional reserve banking system into fully reserved stablecoins. Every dollar that makes that journey is a dollar that can no longer be multiplied through the economy. The result could be a massive systemic contraction of credit. It would become harder and more expensive for everyone to borrow money. This isn't just a problem for banks, it's a problem for the whole economy, which runs on credit. The very law designed to secure the financial system could inadvertently trigger a severe credit crunch. It's a deep irony. In the name of making one part of the system safer, regulators may have just destabilized the foundation our entire economy is built on. When a big chunk of deposits leaves the banking system and the ability to create credit shrinks, the consequences won't be small. They will ripple out in a domino effect, touching every corner of the economy. We are looking at a future with three deeply concerning scenarios. First, and most immediate, is the great credit crunch. For generations, we've lived in a world where credit has been mostly easy to get. The ability to get a mortgage, a loan to start a business, or financing for a car is a cornerstone of modern life. This all depends on banks having a deep pool of deposits to lend from. As that pool drains into stablecoins, the wellspring of credit starts to run dry. The first to feel it will be small businesses, first-time homebuyers, and people with less than perfect credit. Banks will tighten their lending standards dramatically. Even prime borrowers will face higher interest rates as lendable capital dwindles. The cost of borrowing will rise across the board, putting the brakes on the entire economy. The second scenario is the consolidation of the banking industry. This disruption won't hit all banks equally. The giants of Wall Street, the too big to fail banks like JP Morgan Chase, are already getting ready. They have the money and technology to not just survive, but thrive. They are building their own private blockchain networks and tokens like the Kinexes platform, formerly Onyx, and JPM Coin to become the new gatekeepers. But what about the thousands of smaller community and regional banks? They can't afford to invest billions in proprietary blockchain technology. As their deposits shrink and payment revenue disappears, many will face a simple choice: get acquired or fail. The result will be a dramatic consolidation in banking, leaving us with a handful of colossal financial supermarkets and a shrinking number of community banks. That means less competition and fewer choices for consumers. The third and final domino is global. The rise of a dominant USD-backed stablecoin ecosystem has huge geopolitical implications. For countries with unstable economies, a regulated digital dollar is an incredibly attractive safe haven. Citizens and businesses in these nations may flock to USD stablecoins to protect their wealth from inflation and government mismanagement. This is known as crypto dollarization, and it could be devastating for these countries. When a large part of a country's economy starts running on a foreign digital currency, its own central bank loses the ability to control its money supply or manage its economy. In a desperate move for stability, these nations may find they have given up their monetary sovereignty entirely. This future we're describing isn't some far off idea. The building blocks of this new financial system are already being put to use. To see the new world, you just have to look at the use cases gaining traction today. Picture a small e-commerce business in Southeast Asia selling to customers worldwide. In the old system, getting paid from Europe is a pain. The money takes 3 to 5 days to travel through multiple banks, each taking a cut. By the time it arrives, a big chunk is gone to fees. In the new world, the customer pays with a digital dollar like USDC. The payment lands in the merchant's digital wallet in under a minute on a Saturday night. The fee is 5 cents. The merchant can then instantly use those funds to pay their suppliers. Or think about the creative economy. A musician releases a song on a decentralized platform. In the old world, they'd wait months for a confusing royalty statement from agencies that all take a huge cut. In the new world, the song has a smart contract. Every time the song is streamed, a micropayment in stablecoins is instantly sent to the artist's wallet. This is the power of programmable money. Value with built in rules, cutting out inefficient middlemen. Even the biggest corporations are starting to move. Corporate treasury departments managing billions in cash are stuck with the 9 to 5, Monday to Friday banking system. Now they're using stablecoins for payments between company divisions. A multi-million dollar transfer that would normally take a day can now be settled over a weekend in minutes. This frees up huge amounts of capital and changes how global businesses manage their money. The architects of this new world are a mix of old and new. There are fintech innovators and crypto companies building the apps and wallets, but as we've seen, there are also the established giants like Visa, Mastercard, and PayPal pivoting hard. They aren't just watching, they're actively building the bridges between the old financial world and the new one. They're making it easier for merchants to accept stablecoins and for people to spend them, accelerating the decline of the very system that once made them powerful. The evidence is clear. Stablecoins aren't just a new fad, they represent a fundamental challenge to the two pillars that have held up the traditional banking industry for centuries: its monopoly on customer deposits and its control over payments. We've seen how the promise of better returns and incredible utility is creating a powerful pull for deposit flight, threatening the capital that fuels our economy. We've seen how their efficiency is set to destroy the fee income that banks have long relied on. And now, with the arrival of comprehensive government regulation, the floodgates are opening. A law designed to bring safety will instead be the ultimate catalyst, sparking a mass migration of capital from the old system to the new. This will set off a chain reaction, a credit crunch that slows the economy, a wave of consolidation that crushes smaller banks, and a reordering of global monetary power. A faster, cheaper financial system is being born, but its birth may come at the cost of a crisis in the one we've all depended on. The future of money is being rewritten in real time. The only question is, will the existing banking system be a chapter in that story, or just a footnote in the history books? What do you think? Are stablecoins the natural evolution of finance or a systemic disaster waiting to happen? Let us know your thoughts in the comments below. And if you found this analysis valuable, make sure to hit that like button and subscribe to the channel. Thanks for watching.